We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 63. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting at Mama's Basement, and Keith Dicker of IceCap Asset Management in his ultimate dad Christmas sweater. Welcome back to the show. Gentlemen, Keith, what's going on, buddy? I heard there's a big Christmas party at your house. I'm coming over.
Yeah, I know. It's going to be lots of fun. I love Christmas. You know, everyone loves it. It's lots of fun. We have my family arriving today. And Sue will host on Christmas Day. And, you know, I break out my ugly Christmas sweater every year. It's my San Francisco 49ers logo on it. That's fun.
Big 49ers guy. For those
I don't think they wear that in London, do they, Rich?
I'm not in London. I'm in Montreal. Back in Montreal, visiting my mom. It's Christmas. She's bugging me. If you hear any voices on the podcast, it's because my mother insists on talking to me while I'm on my Zoom calls or I'm on the phone or she's about to throw something at me.
Richard.
She's not happy I just said that, by the way.
The wine's going to be flowing at the Diaz household.
That's right. Cheers. Happy Merry Christmas, everybody.
Yeah, this is the Christmas special here. So, I think this is a great place to wrap it up. Like I said, we in last week's episode, we'll continue to sort of pump up the content each and every week here. So we won't actually be skipping a beat despite the holidays. That's dedication. And with that being said, actually, quick announcement. If anyone has any sort of, if you're running a business, if you're connected to the marketing world, we do have a couple advertising spots opening up in the new year. So if anyone wants sort of to advertise in the Loonie Hour, obviously we have to vet you, but there is going to be a couple ad spots opening up. So we'll certainly send us an email. But let's dive into it. You know, there's quite a bit to jump through this week. We've got a little bit more on the Canadian housing front. We've got some numbers from CPI inflation, Canada retail sales, big movements in the equity market, announcements from the Bank of Japan. So there's a lot to get through this week. But I wanted to touch on quickly on really what's happening from sort of the housing sector, which is, we chatted about it last week, which is, national house prices are down 16.5% now since they peaked earlier this year. That's the steepest correction since the index was created back in 2005. Now, not every market is moving sort of the same. There's some nuances, but it's funny. I was looking at the sales figures because the Canadian Real Estate Association doesn't ironically report this, which is the November home sales were the weakest since 2008. So pretty impressive once you actually start to unpack the data a little bit further, because look what just happened with our population numbers. So we had some numbers coming out from Stats Canada, basically showing immigration numbers. So the population growth in Canada was up 865,000 people on a year-over-year basis. So we added 630,000 new people last quarter alone. And so this was the largest influx in historical data going back to the mid 1970s. So when they started really sort of tracking it and had like a clean data set going back to the 1970s, this is the largest increase on record, over 800,000 people. I mean, really, really insane. Then you kind of layer that over and you say, wow, despite that, housing sales are still running at, multi-decade lows. I don't know if you guys have any comments on that. I don't know if you look too closely at the data there, but.
No, I mean, I can weigh in here. I mean, listen, it's a balance, right? Obviously, my mother's making noise while I talk on the podcast, which is very, very frustrating for me because she knows that she can't do that. So let's start over. We've talked about GDP growth being partly a function of investment, consumption, government spending, net exports, and then the other part of the GDP equation is having the amount of people you have, and then productivity growth. And we've talked about how productivity is the most important thing in the world, something I obsess over, obviously. And what this population growth number just continues to do, it continues to hide the lack of productivity growth that we have in Canada. That's the angle that I sort of think about. We're going to get into the retail sales bit in a minute, and how we reference that retail sales per capita, so per individual, is actually basically been flat. And yet we're going to see the GDP numbers, I think they're going to be relatively strong, reflect the enormous amount of people that we're having coming into this country. Again, this is not an indictment on immigrants per se. My mother, who's making all kinds of noise in the background, is an immigrant. I would love her. She's a contributing member of society who's paid an incredible amount of taxes. But it's about how your society obviously integrates them. Can the infrastructure withstand it? Are you getting more and more out of each person who's joining your economy? And are you affecting, let's say, housing or the squeeze on infrastructure? Or we know that there's healthcare issues all over the country, not just Quebec, et cetera. And that's the thing. It's about weighing these offsetting challenges. And clearly the policy right now is just ignoring all the negative externality.
Keith, do you have any comments on that?
Well, first of all, I love Rich's passive aggressiveness with his mom. This is like another classic Rich, awkward social moments with Rich. We get such an incredible insight into way we all live in.
I can see the Christmas dinner just developing now. Mom, the meatloaf.
No, she's like crunching up like wrapping paper or something of all the things. Anyways, that was embarrassing.
Yeah, well, we'll get back to some.
Did your date make it to Montreal?
No, it wasn't a date. And oh my God, Keith,
is there a second date? Is there a second date coming up?
Stay tuned, everybody.
Cross your fingers for Rich. I know, like it's pretty interesting. A lot more interesting than well. Okay, so here are my thoughts on the whole, population growth. I mean, it's a very long-term trend that's taking place. Longer term, as Rich pointed out, if your population continues to grow, and more importantly, if it gets younger and is highly productive, that's outstanding for any economy. Short term, we're obviously going to get some cyclical down movements here, and we're going to start to see those come down Q1. So once we look briefly now at the Canadian GDP and CPI number that came out,
we're going to get into that.
Yeah, and we see the narratives behind what was the market response to it. What are people now expecting the Bank of Canada to do? Which, by the way, no one has a clue because these guys have lost any kinds of. Maybe they gained confidence themselves, but you want to have transparency. So we'll go through all that stuff. But I continue to look very closely now at the Canadian housing market, and everyone, we all own a house in some way or another. Maybe we're renting a house that's owned by somebody else, or we have our own, or we're looking to buy. I look at it a bit differently because I always look at everything from a risk perspective, not a return perspective. Because your return will take care of itself, and right now, you have the data that you can see, but we have the anecdotal stories as well. And anecdotally, it's starting to roll over here. And I don't know if it's rolled over to the point where it's, okay, we could, maybe that's it. Everybody will absorb everything and it'll be fine. But it's increasingly looking like we're going to go into a bit of a hard landing coming up. And I want to talk about what we're starting to see in the bond market, because that's always the big test for everything. we're starting to see that. And then you're starting to see, what's happening with equity markets, that's driving it too. But overall, though, Steve, with back to the housing market, you said it was the worst month since '08. I think you said
worst November since 2008. And again, that's not saying well adjusted for population. It's just saying unit sales every November. So this is the fewest number of unit sales since 2008. And think about again how much the population has
unit sales.
Since 2008.
That's unbelievable. That's a pretty. So I was going to ask you, was it percentage month over month? But it's actually unit sales. That's pretty.
Actual unit sales, right? Like we just talked about. I mean, we added over 800,000 people in the last 12 months alone. So
yeah.
So here's a rhetorical question: what are those people doing? They're not buying their houses? They are.
I mean,
renting.
people always come in. They say
renting.
And say, oh yeah, these new immigrants, like they're working at whatever your local convenience store, they can't afford to buy a house. I mean, I can tell you, I've worked with a lot of clients personally that have come here. They don't buy a house in the first 6 months. Like they definitely go and rent and they add demand to the rental market. But I can tell you, like, as an immigrant, especially from certain countries, like they're like, it's like an honor to be able to own your own house. And so like they scrape, man. They grind.
They got the
grinders mentality, and they will do whatever it takes to try to afford and buy their own home. And it doesn't happen right away, but I've got a lot of clients that have immigrated here. I think one of the big trends we're seeing is definitely a lot of immigrants coming over from India. These are highly skilled workers. A lot of them in the tech space in particular, and they're making pretty good incomes, and it doesn't happen right away. And so I think that is actually like one of my clientele that I'm seeing a larger number of people coming in and like entering the housing market.
So Steve, I have a question for you. Do you have clients or people they're now like they know that, hey, the market is getting softer, and are you aware of a lot of capital that's just simply sitting on the sideline waiting for an opportunity to buy again, or has it changed to where everyone is saying, I'm not touching this for a while now, I'm all done?
Tons. I mean, there's lots of capital on the sidelines. It's just everyone, like we've had so many people that are just like ducks are in a row, just waiting for a better entry point. I think where you maybe have seen like the drop off in terms of like inquiries and stuff like that is definitely like people looking for like secondary investment properties. Like that has definitely slowed significantly. When I look at like our pipeline, it's definitely like a lot of like young families and stuff like that are like money's ready, sitting, waiting for the right opportunity. Like it's always interests me because it's kind of like the same human psychology, which is like, when the market's going up, everybody just follows what everybody else is doing and buys, right? So that's why, at the top of a bull market, when prices are up, 30, 40, 50%, unit sales are at all-time highs because everybody's buying at the top of the market. And then when the market's down, you got 10, 15-year lows and home sales prices are down, double digits. Nobody's buying because they're looking and saying, well, all my friends are telling me not to buy, to keep waiting. So I always find it interesting just from like that human sentiment perspective, the old adage, which is like, buy low, sell high. I don't think anyone actually ever accomplishes that. Very few do. Let's put it that way. Very few.
Or the other one, when there's blood in the streets, which is a bit crueler, but
naturally you think it's just going to keep getting worse, right? I mean, I think the sentiment around housing, rightfully so, is pretty horrible right now.
But if there is a pocket of investors or buyers out there on the sideline in the waiting, are they using if you pick any neighborhood where you are near in the city, are they using like the price point from last year as the high point, or October, November, and at which point would someone suggest to them, hey, I think now is a good time to get in? Are we getting close to that point, or is it still, hey, let's let this play out a little bit?
I think arguably, depending on your situation, what you're buying, there's deals already out there. Like, you've got some of these suburban houses in certain pockets that are, you get the occasional seller that's like motivated to sell and has to get out, and they're 30% off the peak. It's like, well, how much more do you want? Especially if you're going to buy a house that you're going to live in your family home for the next 10 years. So it's a different I think it's like, I don't know. I always view like your primary residence less so as like an investment property. I think the investment side, I always say to clients, you can try to get cute, time the market, because if you miss it, who really cares? You don't have to buy it. But if you're buying like a family home, yeah, of course you want to buy at the top of the market, but like to try to like pinpoint the bottom on a primary residence that you're going to live in for the next like 12 years and you're going to grow a family in, like, I don't know,
You're
man.
way less sensitive.
Go day trade the S&P.
Yeah.
Like,
Well, like when I bought my first home in 1963, I thought I was topping the market then. But then, years later, it starts to play out. But it's all interesting. And in terms of our perspective with the outlook, it's one thing for pricing to come down, but if the cost of financing is not coming down with it, rates continue to go up, bank lending standards maybe getting tighter and stuff like that. I'm less optimistic about a near term bottom.
I would agree.
Being there, I think we're a little bit off.
The optimistic scenario, in my opinion, the optimistic scenario is that like prices go flat. Like that's like the bull case is like prices flatline from here and you have like this bottom. But like my base case is I think there's more downside. Again, each pocket's going to be slightly different. Like, we go back and look at this, you look at national house prices, they're down 16.5% from the peak. They're officially down 4% year over year. I think Toronto's down like 9%. But you look at a market like Calgary's up 9% on a year over year basis because that market was flat for a decade. It did nothing for a decade. If you look at a recent report from RBC that highlighted housing affordability, they said it's the affordability measure is its worst on record. So the affordability metric, which they have going back to the mid 1980s, this is the worst measure of housing affordability in Canada. So it takes about 62 share of income household would need to cover the ownership costs. It's 62% in Canada, 95% in Vancouver, 85% in Toronto. And again, looking at Calgary, for example, it's 41%. So you can see why that market isn't necessarily being impacted very much by higher rates. It's also why, if you look at the population data, Alberta has seen the strongest population growth as a percentage basis. And it's actually seen for the first time in a decade, more people have been leaving British Columbia going to Alberta than people have been leaving Alberta and going to British Columbia. So that's actually flipped for the first time in a decade. So it feels to me, it's like, the old adage was people move to Alberta to get, a job in the oil and gas sector. And now they're moving there just to get like an affordable single family house.
I guess that's why people are also moving out to east. I know the other 3 or 4 provinces that have nailed their population growth numbers. For all our misgivings about people going to Toronto and Vancouver and the misallocation of resources there, I know the PEI, New Brunswick, and Nova Scotia are the top of the table as far as year on year and 2-year growth rates in population. Sorry, Keith, you were going to say something?
I forget what I was going to say.
Classic. No, I mean,
Probably wasn't that interesting.
I think it is like self-fulfilling though, right? It's like, I think like Howard Marks say, right? It's like, the pendulum swings, and like at some point, like the pendulum swings to these extremes in like Vancouver and Toronto, where it's like, okay, well, literally it gets to a point where like nobody can afford it. And like, they start to make plans to leave and go somewhere else. And then the prices will naturally just have to correct. So to me, it feels
I remember now. I remember what I was going to say. That market's getting a bit softish. We are all aware of that by now. But again, the next step is to see if we get a slowdown in the economy that equals job losses, less aggregate income, and all that. That's then when it'll create another leg down in real estate, and it hasn't happened yet. Yeah. But that's what everyone is looking for now, including all the economists out there and the risk side at banks and so forth. So that's where we're headed next.
It's just to quickly touch on that. We'll kind of wrap up the housing front here, but we talked about new listings being the lowest since 2000, new sales, but new listings are basically running at multi-decade lows in like Vancouver and Toronto. And I think nationally, like we're at or close to like 10-year lows. So like you actually really don't have a lot of activity at all in general. So And again, you can imagine, if you're a realtor or a mortgage broker in this kind of environment, like you don't really have a lot of sales, you don't really have a lot of listings. It's just a slow market.
So another question for you on that then, like in terms of, volume, of course, is incredibly important in size as well. But say like year to date this year versus year to date last year, what's the difference in your world, Steve?
In terms of,
I don't mean your desk, but for the industry, like what?
I think the industry has to be down. I know mortgage originations are down just over 30% nationally. So, and I think, so, I mean, depending on your market, you're down anywhere from probably 25 to 40%.
And I imagine like sort of higher yielding type mortgages are down even more.
Yeah, I think it just depends on the space that you're playing in, right? I mean, I would imagine like, okay, let's say, you get some of these like luxury agent realtors that, focus on, they don't move a lot of product to begin with. They move like very high end product. It's like, even that stuff's not turning over now. Right. So it's like, you've gone from maybe you do like 6 big deals a year to like, 2 or 3. It's like, oh boy, like that's a huge drop in income for sure.
I'm more of a yield guy. That's what I like to play.
Big yield guy.
I prefer craps. I like the craps table.
Okay.
But just to quickly kind of wrap up this segment here is we had some more clarity as well on Canada's national foreign buyer ban of residential homes, which goes into effect as of January 1st. I mean, it's classic government. Like literally they've dropped the last bit of the policy. So everyone's like, we know it's coming, but like, what are the stipulations? What are the exemptions? So it kind of left like a lot of like people in limbo of like, what, how does this going to work? They literally dropped the final sort of stipulations yesterday, like 2 weeks before the policy goes into place. But they have exempted foreign students and foreign workers in Canada. So, and obviously if you're a PR, you're exempt, but so basically, my takeaway from all of this is the government says one thing and then they implement policy, which to me signals something else. So when I look at data, you say, okay, well, we brought in over 800,000 people, the most since the 1970s. And you brought in a foreign buyer ban, which exempts basically all the people that you're bringing into the country. So in my opinion, it just kind of just reaffirms like the economic policy in Canada is import people, sell them housing, build housing, and that's it. That's the model. Like bring in 500, 800,000 people a year and sell them real estate. So we exempted them from the ban.
Well, it'll work until it doesn't. So there we go.
Anyway,
Rich, what does your mom think? Ask your mom to come on screen there.
No, that's not happening today. Maybe next time.
Rich,
my mom, you know what? I'm going to be honest with you. I've talked about the immigration situation with my mom for a long time. She thinks obviously immigration is good, but I think her worry as somebody who's 72 years old and has lived here since 1969. Her issue is, it's what do you do with the people when they're here? So like one of the really sad stories we hear all the time is, you're from Tehran, you're a medical doctor, you have a degree, you've been practicing medicine for 10 or 15 years. You come here to Canada, we welcome you with open arms, and then your degree isn't worth the paper that it's written on. And that's, to me, is a crime, right? We're desperate for doctors, we're desperate for engineers. And when all these wonderful and brilliant, hardworking people come here, we say, oh, well, your degree isn't quite as valuable as you need a degree to move here, but when you get here, your degree is not worth it, and you can't go get a doctor a job as a pediatrician or a surgeon or an engineer or whatever. And that it just rubs me the wrong way. Either the person's there's got to be a way around this, and I think some of our politicians in the opposition have started to touch on this, but in general, I find that that's kind of a really sad part. But also Canada's huge, this is the other thing. So it's just a weird one. But as Keith says, I think it works until it doesn't. The reality is we just have a very terrible productivity growth. We don't invest in research and development. And those are the key metrics that we should be judging our economy by.
Well, I mean, the 800,000 people, I mean, what's the strain on the infrastructure, right? Like everybody's heard all the horror stories. Doesn't matter what province you're in, the horror stories around, getting healthcare treatment, right? Going to the emergency room and waiting for 5 hours is a common theme, right? I mean,
that's why it's doubly crazy. I met this guy who was a taxi driver in Halifax. I'll never forget him. His name was Dr. Q, and he was an Iranian pediatrician and had been working in Iran for 20 years. And the reason I met him in a taxi cab is because when he came to Canada and, after demonstrating, didn't want to live in Iran. I think that's rather understandable. Wanted to move his family and himself here. And when he came here, he had to do a 5-year qualifying course to recertify. And it's really, at this point, it's Kafkaesque, right? Like, we desperately need doctors. This guy comes as a doctor and then has to recertify for 5 years. And God love him and his commitment. And when I met him, he was in his 4th year of recertifying, but the guy was in his mid 50s. It's outrageous. There's got to be a way to expedite that. And I feel like that's true of engineers, of electricians. I mean, there's loads and loads of technical kind of skill sets. And the other thing that's really important to note, by the way, is the wages. So in Canada, wage growth is not at all keeping up with inflation. Wage growth is basically moribund, at like 2 or 3%. And it's a function of whereas if you contrast that with the United States, the wage growth is at 20-year highs. I mean, if you're between the age of 16 and 24, wage growth is at 13, 14%. Hourly wage earners are getting more than salaried employees, et cetera. And then that's the reason is because they just don't have the same population growth that we have. And so you have a squeeze of labor shortage. So you have labor shortage. And then so wage growth expands to meet that, supply demand equilibrium. And in this country, that's the other part of not giving, a gentleman like Dr. Q his due, forgive the rhyme, is that you've suppressed wages for working class and people. And you're doubly screwed. Sorry, I could go on and on for that. So maybe we should just switch subject, but
no,
it's really frustrating.
Speaking of inflation there.
Oh yeah, my time to shine.
Yeah, we had a small downtick, very small downtick. Keith, I don't know if you have any initial thoughts, or maybe Rich, you want to unpack the data first, but it seems to me that, like, based on kind of who your data source was or what news rag that you decided to read, everyone kind of has a slightly different spin on the data. Rich, I'm kind of curious your unbiased views of how much sort of weighting you put onto that CPI, and then obviously Keith, your perspective from like a markets view.
So I agree with Keith, but I won't front run him. I'll just lay out the data really quickly, and then we'll hear Keith's point of view. I think the key, so just quickly so people know, inflation headline fell slightly to 6.8%. So the rate of change fell, but it's still well above 2% target. We know the core, which is the thing I look at. So it excludes food and energy. Now you can argue about whether or not that's a sensible thing to do, but everybody does it. So, that's just the way life is. And that rose to 5.8%. So that's a really, really important little wrinkle. Services inflation, which regular listeners will know, is stickier and not related to supply chains in the same way, and not related to commodity stuff, rose to 5.75. So I think that's now at a 28-year high. So again, I mentioned core. Goods fell, but goods fell because of energy. Health and personal care costs continue to accelerate. Shelter, which we always go on and on and on about because it's such a huge part of your core basket, rose on the back of, can you guess what it is, Steve? Rents.
Mortgage interest costs.
Well, that's true. Definitely mortgage interest costs, but also rents. So, the way that you break it down is housing can be part of the services component of housing. There's household operations, literally running a household. That rose to 3.8%. There's owner accommodation, which is your point about literally your mortgage payment. Again, there's some complications in how that's calculated, but maybe that's too nitty gritty for today. But the key thing that jumped like crazy is rented accommodation, which jumped to 5.9%. That's very, very high. And then my favorite absolute chart, as everyone who regularly listens to us, is the 3 preferred measures of core inflation, which ignore transitory and sector-specific fluctuations in CPI, that's a direct quote, by the way, from the Bank of Canada, rose. All three of them rose, one more than others. So we're at like 5.3, and 4.5%. Sorry, and 6.7% for the median, trimmed mean, and factor model. And don't take my word for it, just Google it and you can find the literature. But the point is that inflation, you and me and a bunch of other people we're expecting it to slow, and it has slowed at the headline number, but there's still a lot of pressure with respect to the inflation breadth, which we've discussed over and over again, that continues. And then we're going to get Keith's view on what that means for the Bank of Canada.
Keith?
Yeah, it's so there's a couple things here right now. First of all, monetary policy, it can usually take a year to actually take effect. Maybe 9 months, 15 months, like nobody knows. It's not a perfect science. And so what the market is looking for now, it's clues, because you're not going to get the monthly data coming out to go from 6, 7, 8% down to, a magical 2% number, for example. But we're looking, is it starting to roll over? And even if the numbers are still sort of, high on an absolute basis, we're also looking at what's happening with the underlying monthly data, is looking at growth or wage inflation and things like that. And over the last week here in Canada, it's decidedly, or most people believe, it's getting weaker, right? So maybe all the medicine we took when the Canadians started raising rates there a while ago, starting to hit. The same thing everywhere else around the world. So we're getting closer and closer to when the market is saying, we think you're done. So with the Bank of Canada right now, they're at 4.25%, right? We're at 4.25% for the Bank of Canada. And right now, market is pricing in. Now the market's
Drum
been
roll.
The drum roll. Oh, that's the Yanks.
Drum roll.
Drum roll. Well, the number now is 4.5. So the market is saying, we'll get one more rate hike here in January, effectively, but take and that done for what it is. Yeah, and then they're done. However, also consider that for the last Bank of Canada meeting, the Bank of Canada blew everyone out of the water. No one was expecting what they did. So they're sort of they're their own duck, so to speak. And but right now the market is clearly saying, maybe enough is enough, because we got to get all these rate hikes to everyone now. The mortgage payments have gone up. Maybe rent has gone up. People have to roll over debt, like that debt servicing cost has gone up. Ottawa, Newfoundland, Nova Scotia, Quebec, Ontario, everyone, when they roll over the debt, it's all going to go up. So I think right now we are getting that point. And the key thing is, I like to look at the Canadian dollar all the time. How is it moving? What is it expected to do and all that? See if I can find CAD.
You're talking about
so the other
Keith, go ahead, finish off.
Yeah. So the other big thing. So right now the correlations for everything is +1 and -1. So everything is either moving in the same direction or it moves in the opposite direction of the US dollar. Really, that's what's happening. But Canadian dollar specifically, it had this peak there in the middle of November. And since then, it's been coming off, right? It's coming off pretty aggressively. And even though the data points that came out last week, which was, it suggests it should stay strong, it's starting to sell off again. And it's no longer moving in line with oil as well. So again, it's telling me that, maybe we're done up here in Canada.
It's funny because you're talking about, the rate hikes and how long it takes. I mean, just looking at RBC put out a model here the other day that, they have the debt servicing ratio in Canada. They have it hitting a new all-time record high in Q2, second quarter of 2023. So you can kind of tell it takes a bit of time to sort of work its way through the system. I just keep hearing anecdotally of all the sort of variable rates and the trigger rates and how much everyone's having to sort of fork out on a monthly basis. And of course, those coming for renewal on their mortgages, that tied up a mortgage 5 years ago and are just suddenly being renewed at double the rate, that it is going to bite, but it just takes time to filter through. And to your point there is on the shelter inflation, my God, like rents I'm sorry, but rents have peaked for this cycle. Everyone that I talk to across the country, property managers, realtors, developers, just not seeing it. They're not coming down, but they're not really going up anymore.
So wait a second. I want to, can we unpack that for a second? So what do you mean? Like, you mean the rate of change has peaked, but surely not like in absolute terms, it's not going to come down.
Did you say Shirley?
So
no one's watched that movie, Keith. No one's watched that movie.
Add that to the bingo card.
Oh boy.
So for example, okay, let's say a 1-bedroom condo in Vancouver, Toronto. In the summer, that might have pushed, let's say, $2,000 a month. You would have got like a peak price of $2,000 a month or whatever. It doesn't matter. I'm just picking a hypothetical number. Today, you're probably still getting $2,000 a month, maybe 1980, 1975. But
so you think the rate of change is negative? So the rate of change is negative month on month or quarter on quarter?
Or I would say month on month, it's flat, in my opinion. Turnover rents are flat. So the market, the absolute level of rents, in my view, and discussions with people that are doing this for a living, is that they've peaked. Like you squeeze like the top of the rental market. Like if you had a rental market and you get a unit and you put it on the market, whether it was in Calgary or Vancouver or Toronto, and you listed it in the summer, man, did you get a really, really big number? And you're just not getting that. And today you're lucky to get the same number.
Okay.
So
how does that square with the CPI data that just that just took a huge jump? Is that just a lagging indicator? Is it the way
we talked about it on the way up, right? Like this show, we were like the inflation bulls, and everyone's like, oh, I don't know about you guys, and we were like, no,
fair enough.
Remember we were talking about like, hey, where does Stats Canada, where are they getting their groceries? Like, why is food inflation like 3%?
Yeah, I remember that.
Clearly does. So I just think like that's how I'm looking at like the housing figures, the fact that shelter components still going up. It's like, come on, guys. Like we just talked about at the beginning of the show, national house prices are down 16.5%. Since they peaked. It's not like rents aren't going to be that far behind. I mean, I think there's going to be downwards pressure.
But again, sorry to be annoying, but like the pushback might be if you have that many new people coming into this country, they're all between the 2/3 of which, by the way, are in between the ages of 20 and 50. They're relatively well capitalized. They're relatively employable. I mean, doesn't that sort of put a floor under that $2,000?
Yes, I think it puts a floor under the rental prices for sure. Now, again, how much weakness are you going to get in the labor market? Because at the end of the day, it's like as a landlord, you can only push the rent so high.
Right.
The labor force has to be able to pay for it. And if you know, I don't know, if there's weakness in the labor market moving forward because you have this recession, I think that sort of,
fair enough,
wage inflation a bit. If people are like, well, I can only afford this much in wages because, my costs at the grocery store are up exponentially. And so I just think like, again, I'm not necessarily saying rents are going to come down, but as you know, like the way the BAS is calculated from a rate of change perspective on like a year over year basis, I think you're going to see basically flat to no growth, like by say summer of next summer.
Yeah, that's fair. I could see that.
What about retail sales, Rich? You were watching those.
Yeah, well, retail sales, we talked about a couple of weeks ago, we talked about how retail sales per capita, again, the reason we harp on this population growth stuff is because you can hide a lot of negative news when you just allow lots of people into your country. And so retail sales per capita has been flat since 2018. Remember, in contrast that with the United States, which is up 20% per capita in that exact same time. And so retail sales, not per capita, not accounting for the new people in our economy, have been flat for 3 years. And so the latest data point was basically flat to no change really month on month. I'm not sure what it was relative to expected, but lo and behold, the nominal figure, which does not sort of take into account inflation, sort of ticked up in October. And so that's, like I said, like we've discussed over and over, what matters is per capita improvements in productivity, in wages, in inflation, not inflation, but in retail sales. And so that's what I'm seeing. As far as like the actual individual components, obviously there was some decline. I'm just trying to grab the chart right here. There was some decline in what's it called, in motor, in energy consumption. That's part of the retail sales space. I mean, I know parts and tires fell, used cars and stuff have been flat. But in general, everything's sort of just not doing very well. And I think that's as a function of people retrenching, people getting squeezed on their mortgage payments. And also, sorry, very, very important. The retail sales is heavily skewed towards goods. And we've made that point before, which is they're still spending on services. So there has been a shift, as everyone can obviously sympathize with, away from the spending a lot of money on goods and not going out to spending a lot more money on services and less
that's
money
not bad.
on goods. I think that's a good thing. Yeah, I think that's a good thing.
It's not bad.
It's natural, and I think it's partly a good thing.
The other thing that we see with the retail numbers is that the previous month. So if you're not really looking at this stuff all the time, you're like, well, okay, it's growing, stuff like that. But the way economic data work, you get the number comes out for the month, and then a month later you have a new month of data, but you always make a revision to the previous month. So the previous month data for retail sales, so whether it was like the headline number or you exclude autos are always excluded as well to give you a bit more conservative look. The previous month's data was rounded further down, which changes your base number. So overall, the point is economic growth in Canada, it's getting a bit weaker now, right? That's what we're, and that's the theme that we've been talking about, is that we're going to see it eventually, and maybe eventually is now coming up.
Well,
right?
I think it's a mug's game to like time it to the month. And maybe that's like where maybe we're like excusing ourselves, and our job is to be much more specific and precise about there's going to be a recession on this month and this day on this week. But that's not the point. The point is sort of the central tendency. And I think that's the key thing. I think that whether you look at consumer confidence, which rebounded from its lows, but is definitely trending down, or the misery index, or, the PMI diffusion index, drink, or, you look at mortgage origination, it's not, there's the economy is slowing.
Yeah. So one easy indicator to identify if the economy is growing in one city or retail sales are growing and other stuff like that, it's simply to track Rich, which city he's in. And then like, it's the services sector, not the goods, because he's out at a restaurant and stuff like that on his dates. So I suspect Montreal city GDP will get a little bump there.
Oh man, I wish I was rich enough to. I wish I was rich enough to affect GDP in that way, but sadly, that's not yet.
You are rich. I want to talk about. I want to talk about equity markets and also bond markets.
I was gonna bring you to that sector there. So, I mean, just to kind of summarize there, it's really just like, to me, I'm looking at it and saying, you have your housing data, whether it's Canada and the US, is crap. You've got your car figures rolling over, used car prices down, sales down. I don't know if you guys saw the news today, but I think it was Tesla offering, big discounts, I think up to $10,000 on their cars. So the stock's just been getting hammered. I mean, it's down now, Keith. It's down 68% year to date.
Yikes.
And that was all the Elon fanboys. It was the darling. It was the outperformer. What are you looking at these days? I mean,
well, so very quick with the whole Tesla story, and we never dive deep into company specific stories. It's not what we do, because we like to talk about cool things like central bankers and economists and stuff. But Tesla had a bit of a story going on because their debt was getting called, so that's why the equity was getting hit at the same time. It wasn't, driven by, what they're selling and stuff like that. So I just scolded Steve, I think. Sorry, man.
No. I mean, I'm not a car expert. I mean, obviously, it's just a matter of time. You see all these levered companies that when your debt costs are surging, same as a household. I mean, it's going to hurt.
It's not just that. It's also about competition. I mean, 4 years ago or 3 years ago, you could not name another electric vehicle. Now, for better or for worse, there's, Volkswagen's got one, Audi's got one, whatever it is. I mean, there was these charts going on a couple of years ago about the market cap versus the total number of auto sales. And for Tesla, again, let's not harp on a specific company, but this is sort of an inevitability that I think just took a little longer than people expected to play out.
Yeah, but Rich, Canada's mandating electric cars by 2025.
It's not happening. It's not happening, bro.
Anyways, Keith, continue.
Can you imagine get an electric 18-wheeler trying to like chug it down the road? That ain't going to work.
It's not
going to
happening.
work. Yeah. But Rich made a good point about debt, how it can affect, the equity price of a company. And that's when a company goes from, are they going to produce consistent earnings and stuff to whether it's a going concern. So that's a key thing. So, we're almost at year end. And I think next week maybe we'll go into more year end numbers and stuff. But, about 3 weeks ago, everyone was thinking, okay, we're getting this year end rally. Everything's going to be awesome. My statement won't look that bad at year end and stuff like that. And, and there she was, right? She just left. And so markets are now coming off again. And so this is Thursday, of course. And if you're just looking at the end of day marks on equity markets, the NASDAQ's probably down 2.5, S&P 1.5, same in Canada, basically. But underneath that, man, it was like the NASDAQ was down about 4% at one point today. Like it's starting to roll over. And yesterday, I think I tweeted this out just because a key thing with markets, what you're looking at, is not earnings, right? That doesn't matter, right? That's
I
not
disagree. I disagree.
That's like the European fantasy land and stuff.
Come on.
It's
Don't
the key
mislead our
driver.
listeners.
The key driver of a stock price is more buyers than sellers, and it's the same thing with the housing market and the automobile market and anything, right? You need that, and like you guys were talking about the rate of change there a few minutes ago. You're getting the same thing now happening in equity markets. So we like to call it something, we call it reversals. So you can get market reversal data, and like it'll move in these nice little cyclical movements with a nice gray wave, or band going through, and that started to roll over 3 days ago. You can check my Twitter line. I put out a little model of it to show it. And we've also had trend data has rolled over. So now suddenly heading into year end, we are into this downtrend. It's coming up. And it sort of leads me to the other point I wanted to bring up with equity markets. And this might sound like to be the simplest, investment guide of all time. It's not advice. It's an observation to make when you can get a clue. Has something turned yet? And I know Rich uses this all the time in different markets, and it's very useful. But right now, if you're looking at, say, the 1 year data or year-to-date data on the S&P 500, which is largely the benchmark, for the world stock market, really, because it's so liquid, we're getting lower highs and lower lows all the time. So we had a low back in October. If you want to pull up maybe we'll show this chart, guys. We'll pull this one up, Rich. And you can see it like high and then down low. Up. We had a recovery then into March and April, but not as high as January. And then it came off again. We just hit another high at the beginning of December. And now we're rolling off here again. So we're getting negative momentum into year end. And that's the point with it. And then what you want to do then, because remember, our view is that we will potentially roll lower into Q1 with equities. And it seems like that's, the path we're headed on, the journey we're going towards.
Okay, come on.
I won't say it.
Man.
I won't say it. But right now, that's where we're going. And as a really good data point came out this week as well. It's looking, because we talk about, the economy is going to roll over. It's going to hit the housing market and banks earning stuff like that. What we're really talking about is the bond market. And if you look in, so the U.S. is the biggest bond market in the world, not because of treasuries being issued, but for non-government debt. In Canada, we might have 5 or 6 corporate bond issuers. Like it's nothing, right? There's no corporate bond market in Canada. It's very small. So it's the U.S. market. And as we know, the U.S. market, they can put together like these really cool structures. Everyone knows about the mortgage-backed security market and CDO, CMO, and CLOs. That's the big one now today, collateralized loan obligations. But the way that they're put together, it's basically a basket of a whole bunch of different issuance by different companies. And these baskets now, they're really having this divergence. So you get a section of these CLOs where the percentage of them that are trading extremely high, they're probably of them going into stress is very low, but the bottom portion of it, like it's falling out of bed. So we would call these the hooks or the triple C's. And with a lot of these CLOs, like it's $1.5 trillion in this market. And as soon as a company falls out of this bottom range, these funds, these structures that are put together, they got to dump it. They're not allowed. They can only hold about 7.5% of these funds. And here's the trigger point. It goes over to Europe as well, because everything is connected here. A lot of these issuers that will have their debt dumped in these US structured products, they're also issuing debt in Europe as well. So think of a global multinational company that operates in both the US and Europe. They're issuing debt. That's an example of what these guys would be. And as we're getting stress in this US part of the market, so for example, right now, about 5% of that market, these bonds are trading at less than 80 cents on the dollar. And if you know your bond market world, the way it works, bonds are never, as soon as they get priced to the dollar, it means now they're trading off spread. So if you're a bond trader, you would say, yeah, everything is priced, like at 5 over, 2 over, like it's relative to a spread on another market. Now, a lot of these bonds are being priced, on the dollar basis. So again, it's another sign that the world is getting closer and closer to this recession we keep talking about. And anyway, but that's the point. So with that happening, with equities rolling over at the same time, maybe it is earnings driven, Rich. Like maybe the market is looking through to see, hey, earnings are going to be, weaker here in Q1 and Q2. But right now, like we're finishing the the year on the wrong foot, so to speak.
It's
like the Brits did, right?
Massacre, like 2018. Remember that?
Oh yeah, I remember that. Yeah, I forget what the return was on that day. I think markets were down, I'm going to guess like 3-4% maybe on that day. I don't know, but it was.
They pivoted a month later. The Fed.
Yeah, absolutely. Yeah, because the Fed was hiking rates then 25 basis points, I think every second meeting. Like they were slowly doing it, and then it just got to a point where, I like the you could just see the Fed at the time, like the phones were lighting up. It was the Italians calling, the Chinese were calling, the Japanese were calling. Like, you got to cut this out, and eventually the market did it for them. But the key thing that's different today than back then is that the whole world is coming off zero rates. Everyone's been raising rates from 0 now up to 4-5% aggressively, not 25 basis point hikes, but doing like 50 and 75. And all of a sudden debt has to get rolled over. And this has never happened before. So trying to go back in time and compare this situation, you love the expression, this time it's different. And everyone goes, yeah, it's never different. This time has never happened before. Right. So we don't know we don't know the outcome yet. Right. So
it really is different.
Yeah. Well, we have, because to be different, but to be different or the same, like you need a comp, right? You have to be able to compare it to something. And if anyone can find us, another period where we've had this exact same situation. Remember, debt has just exploded upward, right? Because of the zero rates. So I think 23 is just going to be an outstanding year. The Loonie Hour is going to have a lot to talk about, and I'm looking forward to it.
Speaking of, just to quickly jump gears, we've got a few more minutes left, but we've been tracking. We've talked about quite a bit on the show. Just what's happening. At the end of the day, it's it's a highly complex global financial system. And as we have been chatting a lot about this year, is the US dollar strengthening, the weakness, particularly in the Japanese yen, as they try to sort of maintain this yield curve control. And they're probably the craziest central bank out there. I mean, they're really sort of the creators of QE to begin with. And what is it, so, and Keith, so they just announced they changed their peg on the JGBs. I don't know if you have any commentary on that and sort of what you're looking there from like a market perspective. And I guess maybe ultimately, what are the implications for, say, a Canadian that is probably unaware of what the Japanese central bank has done in recent couple of days?
Well, as an advisor told me before, there's nothing to be concerned about outside of Canada. So you don't need to worry about this stuff, right?
Oh,
I know. Well, that's what I heard. I was scolded about that. And so with the Japanese, what they did, they had a very tight band on where they would allow the 10-year Japanese bond to trade. And it's going to be between minus 25 to plus 25 basis points. So they widened it to minus 50 to plus 50. And that's what created all the chaos. And when it happened, it immediately caused, all of a sudden, the 10-year bond market in Japan. So that fell about 3% for the day. The Japanese yen went up 4%, so it appreciated 4% versus the dollar, and the stock market dropped about 4%. So it was this insane, extreme, volatile policy move that nobody was expecting. Like nobody thought it could happen, but it did. And so the reason this has an effect, because the Japanese, they decided, you know what, the yen's probably off 20%, I think, year to date. I might be wrong if you want to, check it, but it's
150 to 130, roughly.
Yeah, that's 20, right?
Yeah, that's right. Just backing you up.
Yeah, it got to a point where the Japanese said, you know what, we need to shore up the yen here a little bit, so that they managed to do that. And but again, it's another situation where something was about to break in the system, because if they continued along that similar, path they were headed towards, the yen would have continued to depreciate even further, which would have affected the CNY, so that the Chinese currency, the Koreans, and you name it. But it was a pretty big move. But it has so you have that happening, but it has an effect then on the bond market, pension funds, any mutual funds. It's hugely positive for Japanese with money abroad to suddenly bring it back now, because now you won't earn 0%, you can earn a bit more. And the market that actually gets hit the most with this is the European market. So it gets hit in two ways. One is that there's a lot of Japanese investment in the European market over there, which comes back. But also, though, a lot of people around the world, if you are a Europhile, so you're pro Europe and all that, is going to be awesome. And you think we're going to have a shallow recession or a soft landing, then what you want to do is you always want to play the euro yen cross trade in the FX world. So if you think the world is awesome, you go long euro, you short yen. If you think the world is awful, you do the opposite. You sell that trade. So for that day, the worst, even though yen was up versus everything, it was up even more versus euro. So we got to watch this going forward. The other thing, Kuroda, he's the head of the BOJ. He's retiring soon. It's coming up. So the narrative is that he's trying to set the pace so that the new guy can maybe come out of things. But guys, they're not coming out of anywhere. They're just 10 feet under with debt. Like, I don't know how those guys can do it. And they're just trying to survive. Like, you don't want to be that economy that causes everything to flip over. But that's the big news with the Japanese.
Yeah. Yields moved higher, seem across all the markets, eh?
Yeah.
Yeah, they've been spiking higher. Yeah, absolutely.
I just been watching I pretty much just watched the Canada 5-year bond. It's the only thing that's really relevant to sort of my industry. So I comment on that one quite a bit, but even looking at the US 10-year, that's moved up, I think, just over 20 basis points in the last couple of days.
Yep. Big move. It's big moves. I know it doesn't sound like a lot, 20, like 20 basis points on 1%. It's not that much, but it's a lot of vol.
Do you still see the sort of the long bond, the TLT, for example, or something along those lines, not investment advice, is sort of an opportunity at this stage, given the impending recession that everyone has been talking about and bracing for the last 6 months?
Yeah, I think you have to. I think you have to, because like in my world, you have to be invested. You can't be, 50% cash. That's not a luxury that one has. And so you have to be allocated, and you need to be allocated to bonds or stocks. So that's the most important decision normally. Then there's a currency component. Not everyone has to deal with that. And if you have to, in my view, if I have to choose, gun to the head, which one I'm choosing bonds right now, and I'll take, again, non-investment advice, but I would take the bond, the risks associated with the bonds, and maybe the loss in real terms due to inflation, being higher than the yields and all that's duration, et cetera, versus the equity market, which, as Keith said, is making lower highs, is trending lower, is, in my view, at the mercy of really poor earnings and lower earnings revisions and calendar year expectations. That's unfortunate. I mean, and I'm not a fan of bonds generally, but that's sort of where I would hide, let's say, is the way I would position it.
Keith, final comments?
Warm holiday wishes to everyone. We have such a great community here. It's been another whole year, not another whole year, but I think it's just been a great year. And, I think three of us, we all loved this week. And, we spent some time with family and friends this weekend.
Yeah. And we'll be announcing the get together here. We're going to do like a live sort of Q&A social hour. Come on, hang out with us on the internet here. I think we've got it for January the 4th. So January 4th, we'll announce the details shortly for like a link to sort of get together. And like I said, if you want to jump on, it's going to be kind of like a live Q&A, sort of ask us anything really. But just a way to continue to build a community. And we, certainly appreciate your support all this year. And is this the last? We got one more. I think we got one more episode of this year, I guess. So
yep.
I'll save the Happy New Year for the next episode, but appreciate the support as always. We'll see you next week.